again. And Herald Van Der Linde, who's head of Asia Equity Strategy at HSBC, joins in to put the spotlight on the big India call from HSBC and how the macros and micros shape up. Good to have you on board. Thanks much for taking time out and joining in. So just to sum it up, are you saying that despite a few short-term concerns that the macro story for India is looking resilient versus the other emerging markets?
Absolutely. I think resilient is even an understatement. There's a couple of things going well for India. You got, well, at the moment, you actually got some decent export numbers. So some of these IT companies that are coming through. I'm a little bit worried if we go deeper into 2024, that maybe that weakens a little bit. But if you look at the domestic side, investments are good. Consumer is doing well. A lot of the drivers have to do, for example, with formal retail, gaining market share over informal retail, reshuffling of supply chains across the region. Those are not things that come in January or go in February. Those are things that play out over multiple years. So we feel that actually the earnings growth forecasts for India over the next 3 years should actually look pretty good. You're talking about maybe on average 15 to 18% or so. That sounds not bad. Last year we had 26%. This year consensus is looking for something like 18%. So yeah, we can make that assumption that earnings growth is going to hold up reasonably well, and that's a real good thing for Indian equities. So we consider it a market where you want to buy on dips and hold on to it, and that's very different than some of the other markets in the region, which you're showing here at the moment.
Yeah, sure. We're waiting for those dips, though. But nonetheless, yeah. Where is the money going to find its way, though, Herald? Because, you know, the consensus call seems to be it's got to be financials. They're the, deepest sector, and FI money, because it's going to come in hordes and quantums, that's going to move in there. But you know what's interestingly happening here in India is that more than the large caps, it's the broader markets outside the Nifty 50 names where all the action seems to be going on. Do you think there could be a tactical shift this time around? Where could FI spark their money?
Well, that's a very interesting topic. And here in Hong Kong, my colleague Prerna Garg sits next to me, and every day she's looking at all these small caps that are just soaring in the Indian market. My feeling is that there's going to be a rotation from these small and mid caps into the large caps. So you mentioned the banks. I think they look pretty good. The problem I have with small and mid caps is that not only have they performed a lot, but the liquidity can be very volatile in the sense that if markets do turn for some reason that we might not easily identify at the moment, that the liquidity can dry up in those places as well. Another thing that maybe works in favor of large caps is that what we see in India is that a lot of people have been basically buying their own stocks in the market, but increasingly they're putting money into mutual funds. And these mutual funds tend to be more focused on some of the large caps. So I wonder if we're going to see that shift from small and mid caps, strong performance into large caps. Now, that's something that we said 2 weeks ago, but so far, some of these small caps are still doing really, really, really well.
You saying really 3 times really spells it out. But on the large cap specifically, because, of the quantum of FI money which is going to come in, it's typically going to come in into large caps. Where within large caps do you think it's going to flow in? We discussed financials, but outside of that, for instance, IT seems to be making a comeback. We've just heard from the 2 IT bellwethers, Infosys as well as TCS, and the numbers don't look bad, not as the commentary.
No, that's right. So IT, what you just mentioned, right? Just showing up here, Infosys is performing very well today. So the results were not as bad as what the market anticipated. And overnight, we've seen that these ADRs have actually held up pretty well. And I think this is why you got this strong performance in the Indian market this morning. But that's not where I would really look for in the Indian market. If I look at where the growth drivers are, they're more domestic. I think the exporters face increasingly, as we go deeper into 2024, problems that maybe the US economy and Europe, as well as China actually, are starting to slow. So while at the moment the numbers are still pretty good, I wonder if this is still the case in 9 months' time. While on the domestic side, I think the growth is more visible and it's going to hold up better as well. So I prefer domestic-oriented companies. Now, banks are a great example there. One issue with banks, though, is that we see that the loan deposit ratios in India are already quite high. That means that if banks want to extend more loans, they need to get more deposits in. You either raise interest rates to do so, that's not good for your margins, or you just don't do that and say, I'm going to cut down on my loan growth. And suspect something like that will take place in India. So the cost of growth and the difficulties of credit growth will come through as well. So very companies that need a lot of cash, that might be a bit of an issue. But I'm thinking about cash-rich, domestic-oriented companies with strong cash flows. I think about the retailers, some of the jewelry retailers, amongst others, some of the consumer names, staples as well. Consumer discretionaries outperform staples. So I would look in the staple space for relative value in India as well. So yeah, banks, consumer staples, retailers, that's where I would be looking at.
Right, Herald, this is Winnie joining in the conversation as well. Good morning. Let's talk about FII flows, right? They were a bit subdued, but now finally seems like since the month of December, like they're coming back. Seems like it's going to be there for some period of time. Is that the view that you have? Do you think they'll be persisting in 2024, FII flows to India?
Yeah, I think they might well persist. So there's two things going on. First of all, you have money that comes into the region. We see global bond yields coming down. The dollar has weakened a little bit. I don't think that's going to be too dramatic, honestly. But that has meant that people have taken money out of deposits, out of the US into the rest of the world, and Asia's benefited for that. And that explains to a large extent, I think, why money has flown into India. But within Asia, there's a second dynamic. In India, very often people are worried that if China starts to recover, that money is taken out of India and goes into China. That might well be the case, and we shouldn't rule that out. But I think a lot of investors at the moment are fairly overweight on Korea, Japan, and Taiwan. In particular, I think Japan holdings are pretty high, pretty hefty, and in Korea actually as well. And I think this is where the money is coming from. If you look at the relative performance year to date, Korea has actually not performed so well. My suspicion is that within Asia, you have a bit of reallocation of money from Korea, maybe a bit from Japan eventually as well, not at the moment, that could go into China, but it could also go into India, actually. So I'm not too worried about foreign flows for India at the moment yet. What foreigners do have a bit of a problem with is simply valuations. India is quite expensive. So we need to see that growth coming through because that supports these valuations. If that is not the case, we see disappointments starting to come through, earnings downgrades, then that would be a real risk for Indian equities.
But tell me, Herald, I mean, are China, Hong Kong right now only good contra bets because they're coming out of such oversold zones? Or are there pointers and indicators on ground which tell you that there could be a meaningful recovery actually taking place?
There are very early signs that maybe things are starting to improve. On the property side, there are some green shoots. It's maybe a little bit of an overstatement, but there are some signs that things are at least not deteriorating as much as they were 2, 3, 4 months ago or so. As you say so, valuations in China are really low. If you look at trading patterns in China, typically, if you go another couple of percentage lower from here, you're reaching really low multiples beyond which China hardly ever trades. So that is supportive as well. But what is interesting as well is that money that has come into the region because US bond yields have declined, that I mentioned earlier, that went amongst others to India, that hasn't really gone to China. I think people are worried about some of the policy risk in China. The announcements have come through that have really had a big impact on the dynamics in certain industries, gaming most prominently over the last couple of weeks. That has created a lot of volatility in some of these sectors. And people are worried, like, will this happen again? Do I invest in a sector that suddenly overnight regulations change and these companies' valuations evaporate in front of my eyes? So people are really worried about these sort of issues as well. And that is more structural in nature, and that will probably inhibit some of the flows that might flow normally into China. And that's good for India, Japan, Korea, because that's where people then have to put their money in the region.
All right, good to have you on board, Harold. Thanks so much for giving us deeper insights into the latest note and, of course, the India story and where things stand.